A very good afternoon and a warm welcome to each one of you. Thanks for being here today. And we have a wonderful topic to discuss, the home advantage, how domestic institutions are strengthening the alternative investment funds, the private markets, and then what is the future outlook, right? And who better than the excellent set of panelists I have got with me today here, with whom I will do a little bit of crystal gazing, right? See, before I go deep into the questions and throw a barrage of them for my panelists, I would like to quote a little data which will set the tone for the entire session. Today we have more than 1,800 alternative investment funds regulated by SEBI, which is a great number. There is a great growth in that number year on year. Today we have close to 16 lakh crore assets under management for these alternative investment funds. I'm not getting into technicalities or what has been drawn down or invested or what returned. But we are close to 16 lakh crore as per the data we have of the last quarter, right? December 25 we are talking about. Now, when you are looking at this particular data, we also need to see that majority of the investments, the commitments we are talking about in AIFs have been from the domestic investors. I'm not talking about domestic institutions. 52% of the money, the commitment being raised in the alternative investment fund is from domestic investor, but a minuscule percentage of that is actually from the domestic institutions. So ultimately you are talking about the classic ultra HNIs putting in money, the individuals putting in money, the family offices putting in money. So these are the major constituents of this 52% of domestic capital in alternative investment funds. Why I'm talking about all these is that the amount of appetite we have for the domestic capital in alternative investment funds is humongous. Now we are talking about domestic numbers. If you look at the global numbers, right, because that may be a right comparison, you look at US, the global economies, both emerging as well as the grown ones. State pension, for example, has a 25% allocation into alternatives in the US. Now, alternatives are not typically comparable to alternative investment funds. When I'm talking about global alternatives, that may be alternative investment funds, it may be mutual funds also, it may be direct assets, but alternatives is a big part. The insurance you are talking about globally is close to 30 to 40% of their allocation into the alternatives, right? Pension and insurance, and on an average, the banks have a 25% global allocation of their assets. So if they have 100 million, it is a 25 million into alternatives, which can be in different forms, right? You look at India right now, and when you look at the 16 lakh crore of AUM, it is less than 1% of the assets which the DIs have invested into the country that way, or the commitments have been raised. You're talking about a 25% allocation into the alternatives, and we're talking about less than 1% of the assets. Now we are talking about the pension. Pension has always been allowed to invest in alternative investment funds. We had master circulars which further enabled it, but we have zero investments from pension into the AIFs. The banks have obviously passed many years seen a lot of regulations, right? And now 5% is allowed without provisioning, and 10% is an overall sort of an investment, and 20% can be REs. Not getting into that, but bank investments are very low. Insurance investments again are very low, right? We have the government fund of funds, a lot of them, it's 25,000 crore, right? Or the AUM of 16 lakh crore we are talking about. So again, to look at the positive side of it, there is a lot of scope which is there. And on that optimistic note, maybe I will obviously will have to start with Ruchi ma'am, right? Who better to answer the first question? We have her present here. See, a lot has been done, ma'am, by SEBI under AIF regulations in the past. From a governance standpoint, from an investor protection standpoint. A lot of these rights are not contractually available to these investors, right, under their contractual contribution agreements, for example. Now, what's being more done by SEBI? What do you think, what you are doing more here, right, to attract that domestic capital, domestic institutional capital, I mean, into the alternatives?
Hello. So let me start by saying that the institutional investor money is accountable, to their constituents, their stakeholders. They are playing a fiduciary role, and in the past, we have played, as you have already mentioned, that as far as governance is concerned, SEBI has taken great initiatives, especially in the Regulation 20 the kind of role and responsibility that has been assigned to the investment committee and the investment manager gives a lot of confidence, I would say, can give a lot of confidence to the institutional investors. So I would say that the foundation of institutional money coming into AIF is trust. It looks like a motherhood statement, but that's I would say is the spirit or the essence of any pooled investment that happens into public or private markets. Being private markets, they are more obscure and not so transparent, and hence more need to have the kind of trust which is built on transparency. So all the initiatives that we have taken to bring in more transparency, whether it's performance measurement, you know, where it's in terms of the pro rata and pari passu rights, whether it's in terms of tranching. So as far as possible, and I would believe that lot of foundation work has been done. Now, like parents can guide the child, but really cannot and should not hold hand and tell where to go and how to go. So now it's the industry's, the ball is in the industry's court. They have to introspect and see that the kind of events that happened in the past, which sort of brought, I would say that it led SEBI to look at how to build in more due diligence when the investments are being made, and we have put that kind of framework in place, because of which RBI, you know, has been able to give more liberty. Initially, they were on the back foot, but they realized that the kind of in the regulatory framework that is provided by SEBI can allow them to let their regulated entities indulge more with AIFs. And NPS also, we are saying we have Suparna with us, and the kind of initiatives that are being taken there within the 5% allocation that can go. I would say, I would like to believe that institutional investors are wanting to trust the AIF ecosystem, and you should, as an industry, the industry should build up on that. Having said that, what we are going to do in future, if there's anything in the future, so yes, we would like to collaborate more, understand more from institutional investors, get their feedback as to if there still are some bottlenecks, which as a regulator we can resolve without making this light touch regulation into, as is the complaint of the industry, you know, very rigorous. As you are aware that we started with the large value investment framework where only accredited investors of institutional nature were considered with flexibilities. And then we realized that the ticket size 70 crore, the feedback was too big, so we've scaled down the ticket size to 25 crore. So these kind of initiatives are a result of feedback system working. So in future, we would want that more such feedback works, and we build up on the framework which is already available.
Absolutely, thank you so much for the inputs, ma'am. There's a causal effect, right? Because whatever data I could have quoted, this clearly reflects one fact, that regulations clearly are defined by what kind of capital is being raised by alternative funds, right? That way. Now, if you have a deep institutional capital behind your alternative funds, then regulations obviously are low. But when we are talking about capital which is more ultra HNI, family offices, and less domestic institution, then obviously regulations have to be a little more, right? So that light touch really happening is also going to be dependent upon the fact that how much AI investors, right? SEBI is putting so much of focus on accreditation, the AI investors, and how there is a clear roadmap that how the regulations will keep coming down as and when the AI investors or AI only funds, so many initiatives have been taken. So that's well understood. Thank you so much, ma'am. Vikram, coming to you, I think the next one is, you have seen a lot of initiatives have been taken by the government, right? A lot of fund-of-fund initiatives, and you have seen the RDI fund. You're talking about sort of a year time horizon for 1 lakh crore to be put into these assets. Obviously, not only in alternative investment funds, but a variety of other assets. But do you think that a little more needs to be done there? Because I quoted a number as a 25,000 crore fund-of-fund money from the government, which has actually gone in form of commitments. But you're talking about a 16 lakh crore commitment which is already there. So I think that there's little more which needs to be done, and you are a champion, like with the government, you have done so much of work. You will have great insights there, please.
No, so thank you so much. It's great to be here amongst all people here. So actually, if you look at the macro picture, I think the startup ecosystem started building with the term startup becoming very, important term from 2016 onwards, and now we have over 212,000, 213,000 startups in the country. And you mentioned 1,800 AIFs or funds out there, which is actually amazing. The numbers are growing every day. Given that, and of course, a sizable number of funds are actually going out in the market, raising their first-time fund, I still believe that there is a substantial gap in terms of the demand and supply of capital, especially in terms of how much the startups are looking for. Even if you take that ratio down to those 200,000 plus startups, about give and take about 50,000 startups which are seed funded, and you're talking about roughly about 8 to 10,000 startups which are Series A funded, and we're talking about 125, 126 unicorns. And if you're looking for adding another 500 unicorns in the next 10 years, you can imagine the kind of capital which is required to really go with that kind of a growth. And you can't really keep depending on the dollar capital to come in, right? So we know what's happening in the global markets, and we have to be self-sustainable when it comes to domestic pools of capital, and that's where Mr. Sarvana is here with the name Self-Reliant India itself, so that we have to be self-reliant. And I think I would say that big congratulations to the government in terms of taking all the right steps, not only to set up the right pockets of capital. We are beneficiaries of different pockets of capital. We are 100% domestic capital, manage about 6,000 crores over 3 funds. And a substantial part is institutional capital. So almost close to 80% of our capital is Indian institutions, coming from 28 Indian institutions. I think that itself is an indication of the potential which is sitting there with the domestic pools of capital. And I think to your question, can more be done? And I think, of course, more needs to be done. And we talked about NPS, and Suparna ji sitting here, and I think I'm already hearing very positive movements happening in that direction to unlock the pension money, and I think a lot of discussion has been going on, and I think that pool itself is pretty sizable pool, and given the number of funds you're talking about, I think that unlocking of capital will actually further build a substantial dynamic ecosystem. And I think overall, and I raised my first domestic fund in 2007-8. I'm talking about from 32 Indian institutions. When venture capital term itself was very less known, even though coincidentally AIFs used to be earlier called VCFs, venture capital funds. But I think the world has changed quite substantially, and institutions are very actively participating. More pockets of capital are getting unlocked. Family offices very actively participating as well. So very exciting times, and very excited to be part of this ecosystem and building it up from here.
We're talking about NPS. We have 14 lakh crore assets with NPS. And 25 lakh crore with EPFO. We are talking about 5 lakh crore invested in public markets. So hope pension is listening actually, that it's time to put in some money in alternatives also. So no, thank you so much for the wonderful views. And obviously you have mentioned, coming to Mr. Sarvana, obviously you run SRI fund, and everybody wants to get that kind of a domestic institutional money. Talks a lot about the validation for that particular fund. So how that kind of money is helping the startup ecosystem, even indirectly, right? Because you're putting money in a lot of these funds, with 20% you are putting, the rest is being put by others. So overall, how you are developing the entire ecosystem in India on the private market side?
Thank you, Tejas. Thank you for giving opportunity to me to participate in this IVCA conclave. See, I represent the SRI fund. It's promoted by the Ministry of MSME, Government of India. It's a basically public-private partnership fund. It is started during the COVID time to help the MSME ecosystem. MSME ecosystem is a leading vertical in India's economy, plus export, plus even employment. So that time that fund was created in September 2021, almost more than 4.5 years of existence. And 10 plus 2,000 crores, that means 12,000 crores of AUM. Earlier it was used to be 10,000 crores, and 2,000 crores it is announced in the last union budget, 2026-27 budget. And as I mentioned, as like they just said, it's a public-private partnership, and maximum the government can participate 20%. That means balance 80%. The fund has to be mobilized by the funds, the AF1, AF2 category, like, our Vikram Gupta's IV Cap and whatever, all these funds, who are we empanel, more than 71 funds we empanel. So balance 80% they have to mobilize from either domestic investors, could be institutional investors, or could be the family offices, or maybe overseas. So that way this money, this particular fund to the Indian MSME or startup ecosystem has mobilized more than 50,000 crores from overseas. And currently we have committed more than 8,000 crores out of 12,000 crores. And we have invested more than 750 companies. Out of 750 companies, more than 9 companies were listed in main platform of NSE, BSE. And it's created more than 1.6 lakh of employment, that's social data, because being the Government of India fund, we have a socio objective also there. And more than 1.5 lakh, out of that 26,000 is a women employment. We have more than some 20 women fund managers who are empaneled with us. And one of the fund, what I can mention is 2 funds has invested in one company called New Space. It's basically sensitive AI-based drone manufacturing company. So it participated in the Operation Sindoor in May 2025, and in which it really helped Indian military system. And after seeing the performance, the government of, military, army as well as navy, air force, they are given more than 500 crores of order. 2 of our funds as empanel given money for this particular, startup company. So that way we are directly and indirectly helping the Indian, ecosystem, mainly the, startup ecosystem. And we are looking for more investment into tier 3, tier 2, tier 4 locations. That's our endeavor. And things are going well. Yeah. Thank you, Tejas.
No, wonderful. Thank you so much. I'm pretty sure a lot of these insights, quite a few of us are not even aware that way. Thank you so much for throwing light on these. And coming to you, Karthik. Now, I think we have a very good representation because Vikram is running 6 funds. He has run 6 funds, right? All on the equity side, and you do a mix of credit funds. As Sundaram, we are talking about, you do a mix of credit funds, you do public markets also. So Vikram had raised a point, and my question is around that earlier over-reliance, so what you have seen in the public markets earlier, like how the FPI movement of money would have dictated the terms in Indian markets, which doesn't happen anymore due to the mutual funds, for example. So the over-reliance on the dollar capital we are talking about, that is reduced to some extent because of the hope we are seeing with the domestic capital in India. And what are some emerging trends you are seeing in the LPGP relationship here?
Thank you, Tejesh. Thank you to the IVCA for having us on this panel. You're right. So Sundaram has grown from 200 million to $1 billion, mostly on domestic capital. So we are heavily invested in the domestic capital landscape. A little bit of context setting to answer your question. From a capital formation perspective in India, of roughly about a little over $4 trillion, is really what the capital is, of which actively managed capital, which is largely, as Tejesh said, with select institutions, HNIs, family offices, is only 1.5 trillion, largely in the AIFs and mutual funds. Okay. And within that, I think AIFs and mutual funds also are growing at somewhere at a 35 to 40% CAGR over the last decade. So it's a rapidly growing asset class. And within this, DIIs are now, as we speak, in AIFs, double the FIIs. So which means that effectively that little bit of compensation effect that we talked about is already come into play, and DIIs, as far as AIFs are concerned, are actually playing a very important role. So this is sort of facts. Now, if you see the potential, which is really what we're here to talk about, some of these numbers were staggering to us. So, for example, if we take out the NPS and the EPFO piece, the penetration of mutual funds and AIFs is roughly between 20 to 25%, of the GDP, in a sense. Whereas in the US, to draw comparisons, it is over 55 odd percent. So it's a very low penetration. And even more startling is that deposits in various forms, banks, fixed deposits, CDs, etc., are the largest asset class today in India, 2.7 trillion. So the difference between 4.2 and 1.5 trillion, which are the active managed funds, is actually lying in bank deposits and CDs. So 2.7 trillion or 70% of GDP is today lying earning bank deposit returns. So that means even per conservative estimates, a 5% shift of that capital into alternate investment funds would mean on an annual basis between 100 and 120 billion US dollars coming into assets, just as far as managed funds are concerned. So these numbers are pretty massive. So I think the Indian capital market has tremendous potential to be one of the largest capital pools that are available for Indian GPs. Now, to your point on trends, we've clearly seen, so we deal with a cross-section of high net worths, family offices, insurance companies, some of the pensions, and, wide variety of course, corporate treasuries and so on. So we've seen over the last 3 to 4 years that the depth of their diligence, questions around global standards as far as LPA agreements are concerned, governance touch points, have steadily been increasing, as have the check sizes as well. So for example, a 1 crore investor in our Fund 1, is today a 10 to 15 crore investor in our Fund 11. By the way, we have just launched today our 12th AIF fund, which is a hybrid fund. Also, I think specific asks, I was very happy to note the McKinsey presentation just before lunch, because some of the points that Vivek mentioned as important to international LPs have now become important to domestic LPs as well. So things like sponsor commitments, deployment and DPI pace, questions around style drifts. We went through a whole summer of diligence on one of our credit funds last summer because one of our large investors felt that the sector as a whole was drifting in terms of investment style. So I think the sort of standards of governance and diligence have gone up dramatically. As specifically with institutional and family offices, we believe that there will be even greater sort of levels of risk management that investors in India will, as a trend, seek to manage their investment portfolio and investment decisions. So, we have built our business consequently, around a set of risk management that deals with reputation, assets, governance, and so on. So I think this will be the mainstay, as I can see from a trend perspective over the next 5 years.
Thank you so much, Karthik. Really valuable data and insights that way. I'll do a quick round of one question each with each one of you, being cognizant of time. And next one is for you, Ruchi ma'am. And I think rather it will be an easier one, and I'm not expecting that what SEBI has to do here. I think how important is a collaborative effort between regulator like SEBI and even the domestic institutions. SEBI has done its bit, right? Because you're talking about the PPM template, you're talking about the valuation norms, investor protection norms, transparency, related party transactions being checked. So SEBI has done everything now. For example, for the insurance enablers, the excuse investment rights have already been built in because under Section 27, if they can't invest overseas directly, indirectly. SEBI has done its part. There are a lot of consultation papers which SEBI floats, right, expecting that if there are bottlenecks, even the domestic institutions will have to come and then actually voice their opinion that, okay, other than the returns, what's hindering them from putting money here, right? So how important is that a collaborative effort wherein what SEBI expects even from the domestic institutions and from the other regulators actually, which can really deepen this particular market? You have seen that, because what's under SEBI control, the mutual funds, they have 52 lakh crore investments in the public market today, right? With a 11% holding in all the NSE listed companies. So I think SEBI has really deepened the market with good set of regulations, which we also have alternative investment funds. So what's your take on that?
So collaborative efforts surely are the bedrock of any regulatory policy making exercise that we have. And in the past, we have had several rounds of discussions at various levels. And to mention, as far as the discussions are concerned and policy making is concerned, as you all may be aware that SEBI has standing committees for advisory committees. So these advisory committees have representations from all types of stakeholders, including institutional investors. And separately, we have the standard setting forum. So wherever it is felt that feedback is needed either for policy making or for implementation, we do collaborate, and we would continue to do that. As I mentioned that, and you have also mentioned that we would need feedback as to what other areas we can help out. For example, if it is related to liquidity, we understand that while this is a patient capital, it's long-term capital, but there may be some withdrawal related liabilities coming up suddenly, but the point is that since the investment is very small, these things can be managed, the liquidity can be managed to the other investments that are made which are more liquid in nature. Here basically you are looking, because today no institutional investor can can say that, or I would rather put it this way, that it is diversification is not anymore a preference. It is very much an essential need now, and especially considering the geopolitical risks. So I'm sure that with that purpose, they would come towards AIFs, and collaboration, yes, we would continue to have more and more discussions and dialogue with the other regulators as well as the institutional investors to understand what is the need of the hour.
Wonderful to know. I think this transparency over past many years has really helped actually. Vikram, very quick take from you, your 2 cents on what lessons domestic capital, institutional capital can learn from the overseas counterparts, right? They have such high allocations, so what are they doing it differently than what domestic institutions are doing?
So I think of course, last 12 to 13 years have given a full cycle experience of AIFs, right? So now institutional investors have also seen DPIs in funds. So now they understand how the exits happen. I think the questions initially were, how will the exits happen? Do the IPOs happen? And we've seen 2021 was a big IPO year for startups, and even loss-making companies were doing IPOs at that time. So one of the biggest lessons, I think, is about taking a little bit higher risk as compared to, if you're talking about global such institutions, they have actually seen multiple cycles of exits. So now that we've seen one full cycle or maybe 2 cycles of exits, I think the time has come maybe to increase allocations a little bit more and, basically support this further. And I think we've seen institutions have already started doing that, so which is actually a very positive move.
SEBI has already done that. When you're talking about the performance benchmarking, actually, you would be surprised to know since 2022 with the BSE benchmark, the alpha is 15% actually across the venture capital funds. It's not a bad number. The DPI numbers are out. The credit funds have returned majority of the capital. So a lot is happening actually, which is positive.
Absolutely. So I think the DPI was one of the biggest concerns, but last, I would say 5 years, obviously the funds have given very good DPIs.
Right.
So that has actually been a very positive thing.
A quick take from you, Mr. Savana. You obviously invest with a lot of multiplier effect, but what are those key 1 or 2 things you look into the funds, which the audience would like to know or fund managers would like to know, to keep in mind before investing in them or considering them for investment? The daughter funds, while choosing the daughter.
Just ours is a fund of fund. So we empanel the funds, AIF1 category, category 1, Cat 1, Cat 2 funds. So when we empanel the funds, we look at for various parameters. Even the fund has a past track record, assuming that the fund managers has a past track record. What kind of a DPI they're given. So we give less weightage for the MOEC, but what's the kind of a DPI it is given. Then what kind of a governance framework they operating or operated earlier. And third is even the team strength and team quality and cohesiveness, how long they get along, And fourth could be even the where they plan to deploy the money, what kind of a sector or what visibility they have for whatever 8 plus 2, 10 years time frame. So all this data we look at. So when they invest in a investing company, then they look at various parameters, like the investing companies, promoters, and even the need for that, investing companies offering, either could be product or maybe services, need to be there. Without any need, that normally any startup ecosystem may not succeed. There should be need. Then their corporate governance of the investing company's promoter and visibility going forward, and what kind of a financials they are operating, when they're going to reach a break even. So you cannot do a cash burn for a long period. So these are the important factors in which our category 1, category 2 AIF funds, they look at the investing companies for investment.
So wonderful, thank you so much. So the buzzer is on, but we exactly have 8 minutes, I believe, or the 40 minutes allocated time. I'll quickly wrap it up. One last question to you, Karthik, that you really see that mutual fund thing happening vis-a-vis the alternative investment funds, and there will be the domestic institutions who will play the same role. A quick 2 cents from you before I try to conclude the round.
The bell always rings when I'm talking, but nevertheless, no, I think the quantum of capital is very essential to make an impact, to say AIF sahi hai. So I think, the constituents of LPs to AIFs, are supposed to be larger ticket, more sophisticated. So, it's not really designed as a purely retail product. But having said that, I think if some of these initiatives of NPS opening up, EPFO potentially, and insurance regulations, and you remember each of these constituents have separate set of regulators. So if they sort of open up capital together with that shift I talked about earlier, in terms of bank and deposit money moving, I think it can be a pretty heavy force to reckon with. So I think $165 billion in 10 years is pretty quick. So I think the next 10 years can actually, be non-linear.
The alternative sahi hai, that way. We will have a tagline very soon, maybe that way. Ruchi ma'am had done that in her role with the mutual fund industry long back, right? She drafted a lot of regulations. I think we have her for alternatives playing the same role, right? You can see that happening. So it's a matter of time.
I would just say that yes, this is an inflection point, and from a niche product, there are chances that this becomes a mass product, and especially if we have accredited investors on board and the accreditation picks up in the way we look at, we would like it to. And we have already said in our consultation papers that accredited investor only regime may be also something which, can be considered. But obviously there are a lot of, like our chairman has said recently that, it's a long journey, and each one has to play their role. The regulator has to provide enabling framework. Investors have to invest with awareness, and industry has to play a responsible role with prudence. And prudent AIFs can really help in getting the long-term capital that India needs from domestic institutional investors.
Just to support this in number, AIF AUM was 5% of the mutual fund assets 10 years back. It was 10% 5 years back. Today it is 20%, right? Because you're talking about 16 lakh crore versus 80 lakh crore. So you're moving, right? Because it has to be patient capital, but we are obviously taking good steps there.
All these percentages are based on valuations, so let's not.
They'll keep changing, right? Because if 10% markets are down, you don't know what happens. So I'll just quickly wrap it up. There are a lot of good inputs which we have received. I always try to do it in 4 minutes or 5 minutes towards the end of the session, a very quick rapid fire round. There's a mix of a KYC, regulatory KYC, and Karan Johar, sort of a coffee with Karan. So I call it as a know your panelist. The lighter side of them, what you obviously don't know, right? So I'll start with you, Ruchi ma'am. One word answer is all what I'm asking for, right? Couple of minutes, I'll just wrap it up. One web series or a movie or a book or something what you would relate with financial markets. They're really, really well crafted, really well defined how the market function.
When I watch movies, I really don't look at those which would pertain to capital market. But there are lessons to be drawn. So Jo Jeeta Wahi Sikandar is maybe one of the movies which I would say is.
So with you, the same question, because I'm going to raise to all 4 of you.
Reading mostly the financial world books. See, even there is one book called Private Equity 360 by Mr. Vinith Rai's book. I read some time back. He's a is Aviskar Capital's managing partner. This is a good, the book relevant to the Indian VC PE ecosystem. Then like that, I love to read
Great.
books.
Karthik?
I was going to say billions, but I think it looks like Game of Thrones.
Maybe not necessarily directly in the Indian context, but Suits actually talks about the other side of the, capital markets, looking at from the law perspective.
Yeah, wonderful web series. Nobody talked about The Big Short or Margin Call or something, right? Everybody wants to be optimistic. Wonderful. The very next one is for you, ma'am. What if you would not have been the regulator, right? Which alternative profession we would have seen you today?
हज़ारों ख्वाहिशें ऐसी कि हर ख्वाहिश पे दम निकले, बहुत निकले मेरे अरमान लेकिन फिर भी कम निकले. So I would just.
Oh, that's a wonderful one. Thank you so much. Got it. Savana.
I love games, watching hockey and whatever, so.
Sports administrator.
Sports administrator.
I would be probably with my guitar on the railway station.
On the why railway station, right? You have raised so much of money for your alma mater, right? IIT Delhi is blessed to have you with your guitar. I think how many crores you have raised for them? Hundreds of them, right? Like, you're popular for that.
I think music actually brings you together and binds you. So it's also has an emotional appeal. So I think it works.
In IIT you raise 100 crore like just by playing guitar once, right?
It works.
So Ruchi ma'am, one thing which people don't know about you, obviously we got some insight from what you just narrated that way. Lighter side of you, what like very close circuit will know about you? Like I'll raise the same question to each one of them.
So I do write, poems, and it's not really lighter side because it is quite serious.
Okay.
Again, what I said, watching sports, and I was a university hockey team player in my university, long time back. Thank you.
Stand-up comic.
Stand-up comedian? Wonderful. Sundaram is blessed actually. I'm pretty sure their offsides would be like very interesting.
About Sundaram being blessed, but.
Okay. Here we go. What obviously a trait, the question is the trait which people don't know, right? Only the close circle people will know. Everybody knows you play guitar, so don't talk about that, right?
The trait, I actually, I started my fund with absolutely negative capital, not even zero capital. So I like, doing things out of nothing. So basically, it could be anything. So it's like just trying to build things from nothing.
Right?
Yeah, what about a moderator?
No, should I answer all these questions? I probably would have been a cricketer. I would have been a fund manager. The Big Shot is something what I really would have liked in that way. पतंग उड़ा रहा होता था मैं अभी भी कहीं पे lighter side people won't know I would have still done that or meditated for months and months, right? A lot of things in that way. So the last question is who is your inspiration in the financial markets overall ecosystem?
So Warren Buffett.
Good answer.
Rakesh Jhunjhunwala.
Might be slightly controversial, but Elon Musk.
No, it's not.
Yeah, I think I would have said between Warren Buffett and Elon Musk, but yeah, I'll go with Warren Buffett.
Wonderful. I will go with Elon Musk. So you have three doing that. So thank you so much. I think, do we want to take one question from the audience, or I think we have good inputs. I believe we had a wonderful session already. Time is up, so no, that's fine. We are done within our 40 minutes. Yeah. So we are done within our allotted time. Rajat should be happy. Not a minute we have crossed, right? As always. You want us to take one question from the audience, or you want to cut it short now? 40 mein kar diya hai maine boss. As always, crisp, right? All right. So we all are available for any kind of questions you have. We are here for the entire evening. So please feel free, and we can give you answers which probably we can't give you while sitting here in our positions. So yeah, that may be even better. So thank you so much for wonderful inputs and for your time, and thanks for being a very patient audience. Yeah, thanks.